Welcome to Wealth Builders Wisdom. Today, we delve into the mind of one of the greatest investors of our time, Warren Buffett. If you're just starting out on your investment journey, or even if you're a seasoned investor looking for a refresher, you're in the right place. We'll uncover Buffett's 3 foundational rules that make investing not just a financial endeavor, but an art. So, sit back, grab your notepad, and let's embark on this enlightening journey on the timeless rules for beginner investors. Inspired by the Oracle of Omaha himself. Imagine starting your investing journey at the tender age of 11. And while most of us were probably still trading toys, some were trading stocks. And in those early years, many dabbled in various strategies, from trying to predict stock movements based on graphs, to chasing after every new and shiny investment fad. Fun, yes. But fruitful? Not always. The turning point for many is when they stumble upon true investing wisdom. For example, in 1949, a pivotal book called The Intelligent Investor by Ben Graham made waves in the financial community. This wasn't just a book, it was an epiphany, a revelation. It illuminated 2 foundational concepts. A stock is not merely a ticker symbol or a blip on a screen. It represents a piece of a real business. And the real value doesn't come from catchy names or colorful graphs, but from the inherent qualities of the business it signifies. Market fluctuations are inevitable. The stock market is akin to a business partner, albeit an erratic one, offering different prices daily for the same asset. The trick isn't to be swayed by this partner's whims, but to patiently wait for those moments when the price is irresistibly attractive. How often do we let stock prices dictate our emotions? If they rise, we celebrate. If they plummet, we despair. But in reality, stock prices should serve us, not instruct us. Take Mr. Market as an example. He's unpredictable, sometimes rational, sometimes overly optimistic or overly pessimistic. However, it's these very fluctuations that provide opportunities. Opportunities to buy $1 for 50 cents or to sell when prices defy logical reasoning. But here's a golden nugget: always maintain a margin of safety. Think of it as a buffer, an insurance against unforeseen adversities. Now, when scouting for investments, look for businesses with enduring competitive advantages, those with wide protective moats around them. Why? Because in the dog-eat-dog world of capitalism, every profitable venture will attract competitors. And only those with a robust moat can fend off these threats and maintain their profitability over the long haul. And there lies the beauty of intelligent investing. It's not about being swayed by the latest trends or being cowed down by market dips. It's about fundamental analysis, patience, and discipline. If you're enjoying this video and the wisdom it brings, do consider subscribing to Wealth Builders Wisdom. Your support means a lot to us. One more crucial aspect: management. Ensure the company you invest in is helmed by competent, trustworthy leaders. After all, the ship is only as good as its captain. In essence, investing isn't about speculating or trying to make a quick buck. It's about researching, understanding, and then making informed decisions. It's about seeing a stock not as a mere ticker symbol, but as a part of a business. Moreover, one might wonder, what makes one business a more worthy investment than another? It's the business's intrinsic value. But determining that isn't just about crunching numbers, it's about understanding the industry, foreseeing potential challenges, and gauging the company's ability to navigate these challenges successfully. In this world of digital disruption, some industries undergo massive transformation. For instance, the traditional brick-and-mortar retail industry had to evolve rapidly with the rise of e-commerce. So, when evaluating such industries, you should not only look at present profitability but also assess their adaptability to change. Another vital aspect to consider is brand loyalty. Companies like Coca-Cola have cultivated a global reputation and trust. No matter where you go, the red and white logo signifies a refreshing experience. This kind of brand strength is an invaluable moat. But remember, even the strongest of brands can falter if they rest on their laurels. Kodak, a once household name, missed the digital photography revolution, leading to its decline. This underscores the importance of adaptability and innovation, even for established brands. Then there's the question of price. Intelligent investing isn't about buying the best companies, but buying great companies at reasonable prices. Market overreactions, both on the pessimistic and optimistic sides, offer opportunities. For an astute investor, market downturns aren't a source of despair but a window to buy quality stocks at discounted prices. Also, consider diversification. While it's essential to be confident in your investments, it's equally crucial to diversify your portfolio. Think of it as not putting all your eggs in one basket. Market dynamics can be unpredictable, and industries can face unforeseen challenges. A well-diversified portfolio can cushion against such unforeseen shocks. Another key principle to remember? Avoid herd mentality. Avoiding herd mentality is fundamental. Just because everyone is flocking towards a hot stock or trending industry doesn't mean you should too. More often than not, by the time a trend reaches the masses, the real opportunities have already been capitalized upon by those who saw it coming early. Following the herd can often lead to inflated prices for assets that may not have as much intrinsic value as their price suggests. Take, for instance, the dot-com bubble of the late 90s. Everyone wanted a piece of any company that had a .com in its name. But when the bubble burst, many of these internet companies, which had sky-high valuations but no actual profitability or even a viable business model, came crashing down. The investors who had done their homework, who had looked beyond the hype, were the ones who emerged relatively unscathed. But let's also talk about the psychology of investing. It's natural to feel elated when your stocks are performing well and despondent when they are not. However, it's crucial to separate emotion from decision-making. An emotional investor is prone to making impulsive decisions, buying high out of greed and selling low out of fear. The intelligent investor, on the other hand, remains calm and rational, always keeping an eye on the bigger picture. There's also immense value in continuous learning. The world of investing is dynamic, with new industries emerging, market dynamics shifting, and technologies disrupting established norms. Regularly updating your knowledge, not just about the market but about the world in general, can offer invaluable insights into potential investment opportunities. To wrap things up, investing isn't a get-rich-quick scheme. It requires patience, diligence, and above all, a desire to learn and understand. While the market's ebbs and flows are inevitable, armed with knowledge and a solid strategy, you can navigate these waters successfully. And as we conclude this deep dive into the realms of investment wisdom, remember, the journey to wealth isn't about chasing trends, but about making informed and intelligent decisions. If this content resonates with you, do like this video. And for more deep insights and wisdom on building wealth, hit that subscribe button. Together, let's make smarter financial decisions. Stay informed, stay invested, and stay wealthy.